All right, guys. Today we're going to talk about taxes a little bit, and answer a question about risk levels, as well as a question that Cook had about systems. That was all from the content request channel. So, in the future, if you would like to see certain things talked about that we haven't touched on, or you want more detail, then leave that in there, and we can do more of these as a result. So these are just the ones that I kind of promised in the past, and we're just going to go through them. All right, first of all, disclaimer, I have to say that I'm not CPA. You can read it yourself. This is not like meant to be financial advice, investment advice, tax advice. Basically, it's just anecdotal. It's my experience. I'm here to kind of shed light, maybe inspire you. And a lot of these situations, I found myself kind of ignorant to the process at the beginning. I think it's something worth noting, especially if you're a serious trader. A lot of you will know this information if you already have gone through the process, but I feel like there's a decent amount of people who aren't aware of this because typically people who are kind of first endeavoring into trading, even if they do have a professional mindset going into it, may not be aware of some of this information, and it is time sensitive. All right, so here we go. We have the wash sale, trader tax status, mark-to-market election, and finally I'm going to put some of the links with the recording afterwards so that you guys can take a look at some of the things we're going to preview. But I just want to go over the real basics of points of these. So wash sales, I hear a lot of times people say it's not important. On the right-hand side, we have a little bit of a description there. It says a tax rule that bars taxpayers from deducting the loss on the sale of a security that they replace within 30 days. You may say, well, this doesn't really affect me, but actually it can have a pretty serious effect, like come this time of the year specifically, end of year. Essentially what it means is that if you don't have a mark-to-market election, which we'll get into, just don't worry about that, you are subject to this rule. And what it says is that if you, let's say, take a loss on a trade, like let's say you take a loss on Google, within 30 days beforehand and 30 days afterwards, let's just say today, but okay, so you take a loss on Google today. 30 days afterwards, if you place another trade on Google and you exit that position, it will disallow the loss that you took prior to be deducted from your tax return, like on this year. So you have to carry it over to the next year. And the reason why that sucks is because like you can get into this scenario. So basically, when I blew up my account in 2018, this was the end of the year, like in December/January. The problem with that is because it's so close to the end of the year, because I blew up my account, like lost on one of these trades, like lost 50K or something like that. That loss, because I ended up trading that ticker again, because it was running for multiple days, I took another loss or entered another position. That loss, I was not able to write it off on that year tax return, which is like really sucks. Like it'll literally treat it as if you didn't lose that money at all. And it's okay because it's going to carry over to the next year, but you have to be aware of this because especially right now we're in an environment where you'll see a lot of multi-day moves, at least in the last week or so, maybe not right now, but who knows what happens in December. Essentially, if you have some like IMUX and you held this and you got squeezed up, and for whatever reason you short it again, like because it's constantly running, that's going to put you in a really bad position tax wise if you don't have basic like mark to market accounting. So essentially, my advice to you is like be very careful. Like in December, if you end up trading a ticker and taking a big loss, like I'm talking not just like a normal loss, but like you blow up or you take a bigger loss than you thought, and you're tempted to revenge trade it at any point the next following days, like don't do it. You actually have to literally just ban it off your list because you don't want to get in that position that I was telling you about. This is like where it's going to really mess you up badly. Fortunately, the tax system is advantage for people who are like going to make this a career because like, of course, even though you can't write it off in that year, it'll carry over and you can start deducting that against your income. Just in the following year. So it's like it rewards you for staying in the game. But the problem is that by default, most people are going to be considered investors. To earn trader status, you actually have to meet a certain set of criteria, which are mostly lines in the sand. They're not like hard and fast rules, and you can definitely Google or watch YouTube videos about trader tax status in particular if you don't understand. But basically, you have to like show that you're trading on a consistent basis, trading like good amount of not like crazy size, but you have to trade like material size, and it has to basically be indicative that you're actually doing this like with majority of your energy and your hours and things like that. That is something that you would have to consult your CPA with. But in any case, like my original point is that as an investor, you only can deduct around $3,000. Like let's say you took 50K loss, because your investor status, you can only take off 3,000 of that every single year. And if you think about it, like 50K loss divided by 3,000 will take you a year, like will take you a decade, more than a decade to write that off, right? So it's like you want trader tax status if you're a trader. So trader tax status is super basic. Like now, mark to market, that's one thing that you probably want to know about. So mark to market is like an election that you make as a trader where you can basically, you can look up the exact definition, but essentially what happens is you don't have to deal with the wash sale rule anymore. You can start taking losses and you can start deducting them on that year, just whether or not you trade or not. And one caveat too is that as a short seller, if you took a loss on a short, right, and you initiate a short position on the same stock within 30 days, even if you don't exit the trade because you sell in first, it's actually going to trigger the wash sale immediately. So you can't just hold on to that position until the end of the year or whatever. Like you literally trigger right there. As Sid pointed out right now, don't do it if you're trading futures. This is only for equities. Again, that's my experience with equities. Okay, so I should actually have preface that as well. Equities. In any case, with mark-to-market election, you need to make this determination with the IRS. You have to file an election with your CPA, or you can do it yourself. I don't know how to do it, but I did it with my CPA. You got to do it a year before, like during the tax year this year. So just like without being so wordy, April 2023 is when tax returns due, right? You have to elect for 2024 now. You can't file it and be mark to market in 2023. If you miss the deadline to file it in April, then come 2024 and you start becoming a serious trader and you say, oh, I need mark to market. Now that mark to market is going to be for literally like the next year. And you would rather set yourself up now, which is why it's better to just be like have a CPA ready to go if you're thinking about doing this seriously, and not put that off until you say like make more profits, whatever. The other thing is you want to have like the trader tax status as well, because like I said, those losses you're carrying over, you would much rather deduct that upfront. Like if you took a 50K loss, you'd rather be able to claim zero income on the year. Like if you didn't make any money, or if you made 100K, you lost 50K, you'd rather be able to be taxed on 50K versus 100K, right, this year. Because like, let's say you take that big loss and you can't deduct it now because you triggered the wash sale rule, then you're going to be paying taxes as if you didn't lose that 50K. And obviously, like, you think it's kind of a stupid rule, but basically, like, they do this so that investors cannot sell like positions. So let's say you held Amazon all year, and then it's like you sell it to trigger a loss against your net income. So people purposefully time these losses to offset their regular income or whatever incomes they get, and then they just buy it back next year to maintain the same position essentially in their portfolio for the long term. The government wants to disincentivize people from abusing these loopholes for their income reporting and timing it, things like that. So this is why it affects us. But if you opt into the trader tax status system and you make the election the year prior, now you set yourself up for success. Like let's say you're in year one or in your year two, and you're starting to see like, okay, I can do this, or I'm being consistent, things like that. Like, you should literally have this election put in before April with your CPA, so that you're ready to go on the equity side. That's just basically something that you have to have known that before you got into it. Personally, I didn't know about that like way long ago, and I think it's going to be something that adds a lot of value for your own business, and you don't want to ignore this. I have a couple of helpful links on the subject that I will post. I was originally going to go through, but I managed to just explain it. It's going to have all the details and all that stuff like that. And, you know, I hope that helps as well. All right. So moving on to risk levels. So Big Mac asks, would you be willing to speak on some technical analysis concepts, stuff that we can apply in our own work when we're building our own strategy of our own? Jackson asks if you need a special CPA. You need a CPA that's aware of trading in general. So like I had way at the beginning, I was referred to like my dad's CPA, and he didn't know anything about like trader tax status and shit like that. So you should be very like cognizant of their ability to understand the market. Yeah. Anyway, so stuff that we can apply in our own work when we're building strategies of our own. One area I have difficulty is properly defining risk levels. I have clear criteria for exits and entries, but for some reason I'm always puzzled when it comes down to choosing a proper risk level that isn't too tight nor too wide. Attaches a screenshot of FNGR on 10.6.22. It broke down from a certain level and washed out. Clearly, it never tested any of the possible risk levels that I could have used. So what's stopping me from choosing the tightest risk level and maximizing my risk reward? My guess is overall reliability of said risk level over a large sample size. But how do you test that? Okay, before I go into this, I would say you need to think in terms of that concept I brought up, the ideal trade location versus continuation. This is the Merritt Black's concept I picked up. Something I would heavily recommend that you add into your ethos as a trader. Essentially, it states that the quality of your setup is actually determined more so based on the location of your entry relative to your risk than the actual setup itself. Because let's say you can have like 100 factors of confluence, but if you get in on the bottom 20% of the range and you're shorting that, like there's only so much room you can have for reward, whereas the risk is very high. And the problem is, if you let's say you did short that, like the chart I brought up on the other day, some people appreciate the bond chart that I mentioned. It's like very down, right? At this point, you can say, well, okay, it's really down from the highs. I mean, I have no idea. Like, yeah, you can follow the trend on it, which is fine, short-term trend, but essentially, like, it's a dead-ass chart, and we don't like shorting dead-ass charts because a short already inherently only has a certain amount of room it can revert, typically speaking. Like, a long can go, 1000%. Shorts a lot of times tap out like 50%, like if you're really lucky, and sometimes more, but that would be with other factors. In any case, even if you had some factors, say like dilution or whatever, if a stock is literally already dead, there's only so much you can do in that trade. Because if you, let's say, get in a short towards the lows and the stock is now reversing it against you, and let's say you engineer a stop loss to create like synthetic risk reward, you put a stop real tight so that you can get the remaining move that's expected. If that stop loss triggers out, there's two things can happen. Obviously, one, you're gonna get really pissed off because like I got stopped, I lost money, way too much for this risk level. Number two, you're not technically wrong on the trade because the trade is never really technically invalidated, and so you may reattempt a trade, and you could possibly take several losses in a row consecutively, more so than you intended for that particular trade, just because of the place that you entered the trade to begin with. All right, so by this very thought process with an ideal trade location, that's the point in the stock trend where you have gone the entry relative to the risk that is like quite optimal. That would, combined with a thesis of like, okay, here's the big picture, that would be like your A plus setup. You could have an A plus condition but be way down from the ideal trade location. No longer, even if that's an A plus setup, and as a whole, if you just look at it, it's not an A plus setup where you get in, because where you get in can be like a B, C, or D, or even F type scenario, right? This is the thing you have to kind of recognize in your trading, like how I can differentiate my trades based on the fact of like technicals first to set the baseline for my overall understanding of the three pillars of trading, the news, the fundamentals, and technicals. It's very important to recognize this aspect of trading. Okay, so he attached his screenshot himself, and I have here some tools that I just downloaded. So let's see if this works out. All right, so basically these are the lines he drew. You can basically ignore it. I didn't even really read it because I already know it's wrong. Not to shame, but I'm just saying like you have to really consider a lot of things, and I think you would not have asked this question if you understood anyway. So basically, in this FNGR chart, what I see is, okay, we have an intraday chart down here. I don't know if you can see my mouse, but basically, okay, you can see it, that's perfect. All right, so we have this intraday chart here, and for the most part, people are focused on intraday chart and also focus on basically what's occurring from the market hours. And the reason why this is incorrect is because like we can't call this high of day, right? Because this was once high of day. If that's your metric, I'll use a better color. If high of day after open is your metric for the range, then this was high of day at one point. Okay, now high of day is broken. Obviously, if you risk this and you would have got stopped out number one, then you would have done the same thing number two. What you actually should be looking at is basically the bigger picture. So within this range, here's the high of day. This is where the true risk is. The stock can it can oscillate between this range, and if you're pretty much getting in like here, right, that's not really an optimal risk reward for the trade. Whereas like possibly here, if you had a swing mindset, this is the trouble and difficulty of having a multi-day runner as your type of setup, because a lot of times they don't offer that ideal trade location, and you have to kind of you can't see the epic pen drawings. Damn it. That sucks. Okay. Well, I'm going to assume that no one saw anything there, so I'm just going to use my mouse. Okay, so to restart that a little bit, here's if you had the high of day here from the open, that's just not right? Because even in the intraday chart, we already have this level here from pre-market, and even from the day before, you would have this level as well if you wanted to say risk off a lower high. Basically, you have to look at the big picture. So big picture here, the high was actually 10.1. Anything in between this would just be chop. And for that reason, if you're risking anything like this, you have to assume this is not a very good risk level in general. Like there's the odds that this holds is very low. Like, yeah, it was an inflection point for the moment, but there's no actual like real reason why that would hold. And you're putting undue risk on the trade. So basically what you're doing is you're entering into what I'll call a continuation trade. And a continuation trade is basically, well, we had this move here, and okay, now it's retracing, it's done its retracement to the mean, whatever that was for the time. And now we're bouncing. The trade is now on a multi-day scale. It's not on your intraday scale anymore. So by treating this trade on an intraday scale, you're basically assuming risk that is undue and also engineering the trade, which is nothing wrong with this if you have some sort of edge. But if we're talking about like true risk levels, the reason why you can't accept this is because it wasn't actually a risk level to begin with. You can't call this a high of day. That's all I'm saying. So in terms of the big picture, if this would have set up maybe as an A+ setup, then your stock would have gapped up, like held this gap, and possibly either broke out and failed follow through on that 10.1 level, or you would have been able to risk against that 10.1 level with a better entry in order to capture the downside that you're expecting. At this point, it's basically just mid-range, and I think that's would help you just understand like the idea of ideal trade location continuation. In any case, you have to be able to kind of assess your risk in terms of like, okay, well, if this trade's true risk is somewhere up here in 10.1 level, then is this trade even really worth taking? Like, yeah, you can take it now. Maybe your size is most people can trade this. Even I can trade this. Okay, I'm not saying that like you're going to be invalidated from trading it anytime soon, but basically you have to understand that this is not really a good trade anymore. And for that reason, I would recommend that either you size way down and have very little expectation for it. Treat it as a C trade, D trade, etc., however you want to say that, or just not bother, right? Because like if you told me, Brian, put like this is a D trade, like let's even say I'm just talking to myself. In the morning I go, Brian, this is a D trade. The risk level so far, let's just put on like 0.25 R or something like that. Like my first instinct would be like, why even bother? That's how I would think. But if I'm like thinking of the intraday and I'm like looking for all these pivot points, like, oh, here's the high of the day, then I would be like, oh, I can get a tight risk right here, and I think it can pull back, like, whatever. And then you start, trying to put the full risk on, but then you only think of the reward. So what happens is if this flimsy high of day breaks out, then you could be like, okay, I'm not wrong. Let me get back in. Oh, stop out again. Oh, I'm not wrong. Let me get back in. Stop out. And you could do that all the way until the high, because essentially, like that is basically where the trade would be wrong for sure. Everything else is kind of a risk. So, that's the problem with this kind of thinking. And it's not something that I particularly overcome myself, but it's something I'm working on for sure. All right, so I'm going to give you some more examples. So today's TSHA, very relevant example today. So we have here, the pre-market high set out here, right? So ideally, and what would an ideal trade location be? It would be like, okay, your entry somewhere in this area at least, right? The fact is, the stock pulled back and it's fucking dead. And sure, you can pull a bit more, but like in all cases, it's a continuation trade. No matter you saw an ATM, whatever, no matter they need cash, whatever, like this is not a trade you can risk on. So what would happen is you put the risk on, you could put the risk on here. This would have been okay. It's probably the most optimal entry you probably could have gotten, possibly, is like, you have to risk that, right? You could say like, well, it's an ATM. ATMs, they bounce, they fail off of the VWAP, whatever. They're meant to be heavy. Sure. Okay. So you can say, well, the properties of an ATM, big picture, they act certain way. So like I can maybe reduce my stop. Like, I can maybe use this high, or I can use a little bit above, whatever. You can pull whatever level you want, basically. Thing is that level, no matter how much you engineer that level, it will never be an actual risk level. But you can infer based on your experience, or basically on your expertise of how an ATM should act, that, okay, well, if an ATM is fully diluting, then pretty much this bounce should be the end of it. Maybe one more at the open, and then we should see more down selling pressure. Fact is, this high, sure, you can use that. You can start adding in whatever, but as soon as this starts chopping around and not acting like an ATM, that is the problem. And you should recognize basically like that's invalidating your idea of the big picture. And then secondly, even if you don't consider any of these factors with dilution, fundamentals, things like that, once this level is broken, like here, this doesn't even mean anything, because it doesn't mean you're wrong actually. So you see a breakout and you're like, oh, okay, well, I stopped out. And then it slams back down. You're like, what the fuck? And then so you get back in, right? And you're like, okay, I'm just going to risk this instead, or I'm going to risk a little bit higher. And then it just grinds on you, and then you lost again. And you can do this process until this point where, okay, oh my God, okay, here's where I should have got in, because this is an ideal trade location. So I wish I had my pen right now so I could draw the line. But if you can just imagine, like you see here at 2.6, there's a line here. At this point in time, you can get a really good risk reward. You can put good size on if you were thinking the move would come back down. And this is essentially where the trade would have been, like on that A territory. So you see this washout. Oh, hell yeah. Now I'm going to start reducing my risk, whatever. Or maybe not. Even just let the trade work because you still have a good position. And then boom, straight through the highs. Now this is where you're wrong in the trade. And it's already gone this far. And how many times you lost already? You lost 3 times or more. So as you can see, like when we're talking about risk levels, we actually have to define like the true range of the stock. We don't know if this is the high is going to be the high. Like it could just out the gate break the high in the next 5 minutes. But the thing is, like, it's certainly a lot better to define range based on the range that was already projected before getting into the trade, like the prior high, than some random levels. Like you can't pull this line, you can't pull this line. There's no merit to any of these lines. There's none at all. So that's gonna be a really big problem. Can you talk about FNHC trade? I don't have that one on here. Sorry. Do I use time stops? No, but you can. All right. So this is pretty basic example of today, and I'm even myself, I got caught on it, to be honest. So I'll tell you what I would have done in hindsight or moving forward. This is the true risk level. No matter I get in here, 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 I should not be saying like picking a level here just to join in the trend. I shouldn't be picking some level here just to join in the trend and trying to get a tight risk so I can get a risk reward when it comes down. Because that's all reward mindset. I should be actually just size against the high. If it works and it doesn't work, it doesn't matter. Because like the trade was shit to begin with, and in fact I should have just not even take the trade. The reason why I would even consider the trade is because the ATMs really is looking very juicy. They need cash, things like that. So there are reasons why like the ATM's price action can play out, but like this is nothing close to a trade that I would think is a ideal trade location, and that has to kind of be affecting your bias beforehand, no matter what kind of information that you pull in from all sources. Because as you can see, the market doesn't really give a fuck what you think, because even a distressed company with all this problems, they can run up. And sure, you can say, well, some of the people doing the underwriting was Goldman Sachs and Wells Fargo. Sure, that's not very normal for penny stock. There may be something to it, but it doesn't really matter. Like you would think ATM would want to raise capital for a company that needs cash, whatever. It's a basic penny stock rule. Anyway, so I'm gonna get into 2 more examples, and I see you guys in chat, but this is not relevant right now. I can get back to it. So here's a PEGY, right? This is one of those multi-day runners from the other week, and the reason why these trades are different is because there's a number of factors at play. So first of all, we must pay attention to volume. So here in 10.5, we have the highest volume by far. And so if you can imagine, like, if people are loading in this area and you see it gap up here, like, sure, there's a mean reversion opportunity, but the actual trade is not like invalidated for the long who's already positioned in this area. In fact, like anyone who bought here was never wrong the entire time. Like not even today. Like they actually have no reason to sell. They have no reason to sell. They could sell into strength, into momentum, sure, but for the most part, like when the volume's all traded here, and you're coming in like this day trying to get a first red day, you're coming in here trying to short it against the resistance. Like at no point do you actually have like an edge unless there's actual selling coming in. You only have edge based on the fact that it's gone up too fast, too soon, and it possibly could pull back like into this range here. But at the same time, you have to be careful once it stops working. And I think a lot of people kind of underestimate that about the multi-day runners, is that the places that volume exists is operating on a level that is more macro to your view, which is more intraday. And you have to consider multiple positions basically, and not just your own, and not just measure extension. Sure, at this point, like we're coming from 2 to 7.5. Sure, now like buyers may become sellers. There may be a supply demand just based on pure technicals, or even just introduction of any new event fundamentally or news or whatever. I didn't really follow the stock too much, but just from a pure technical, like ideal trade location kind of perspective, you have to maybe invert your mindset towards the long side just to like get their perspective. So if let's say you're trading this long, right? If you're long and you bought it here, like this is the ideal trade location. You got in closest to the risk, closest, to the lows, whatever, the closest to the initiation of the move. And of course it's hindsight, but let's say that you're long that's holding multiple days. At no point, if you had a stop loss, would you ever trigger it ever. Pretty much you could add and reduce your stop as soon as this starts holding, and go for more move. And a short seller is thinking, well, this is up too much, I'm going to short it. Whereas like long never ever thought about even like, okay, I'm not even panicking whatsoever. Like, this is great. This is going up. It's probably going to keep going up. That's a mindset most people have. And you should to be really careful with your bias and just keep thinking about that. And the same deal for, let's say, here, like let's say you're shorting it and say, okay, we broke trend. Maybe we can break the low and we can do the whole like first red day thing where we risk like the previous close, or we can risk, red to green, whatever. Even in that aspect of the trade, you're still risking a level that's not hard and fast. But the thing is, like, for those patterns, you can at least expect for it to kind of hold and understand that the trade's no longer there anymore. It's like perfectly fine to attempt it, but you can see that those levels are a lot more technical and a lot more established, like as areas to stop out, versus like the prior example where you just pick a point on the trade, or even if you just project your own point, like there's no real basis for that risk. So just keep in mind with that, and also keep in mind that let's say, for example, with failed fall through momentum, like for example this trade here, if you're trading on this day and you see that it's close to the high, so you're like, okay, I'm gonna have ideal trade location, I'm gonna short it here and hopefully get a pullback. The problem is, like, with a multi-day move, a lot of times, like, if there would be supply, it would have been introduced through fundamentals, and that would have already started pressuring the stock down. So a lot of times, like, where the failed follow through setup itself finds its juice is where, like, people attempt to break the high. So this would be like a fake breakout type of scenario. They attempt to push it over because they're excited, and then selling comes in from like former buyers or from short sellers who are looking to take advantage of people chasing the highs. You're not even guaranteed like you get a full reversal on the stock, but that would be like the initiation of why a stock would pull back, and why sellers would come in. So you have to be careful and plan differently accordingly to the setup. So just to reiterate, like, when you're on this day, you can say, well, okay, I'm going to do ideal trade location, risk against the high. But at the same time, you also need to either have this as your main entry or just have this as a backup. Is that the failed follow through setup is probably more so applicable to this trade than anything else, and that typically requires that something is breaking out and finding some pressure. That was the only example I had? Okay, well, anyway. So I thought I had two. Well, it's gone. So anyway, so here's Cook's question. This one is not related, so I'm going to circle back to the questions in chat and then get to this one. So Sid, off the answer is last. Trade down the hill. How do you manage high day clearouts usually? So for me, high of day clearouts happen based on setup. So for example, if I'm looking at PEGY, like if it's on this day and it's poised for a breakout, then I will probably execute on a different system that accounts for that breakout. So you can either use like a hard level, like, some people probably will use like over under 5 or 550 or $6, something like that. For me personally, I would just use like percentage spike as my starter. So I want to give myself like a pretty good amount of room for it to like push up, but it's going to be on a small enough size where if I did take the full loss, it'd just be 1R. And that would mostly have to come from your own experience with like how much are these spiking this during this environment or just in your back test. That would probably be the best way to have confidence. Like I can tell you, I could say like, oh, just use like 5% or 1% or 10%, 15% of the high, right? But if you never backtest yourself, verify yourself, then you will have no confidence to take the trade in the beginning. So there's no point for me to even to tell you that. You just have to understand like how you could approach it. And then, personally for me in these setups, I have signals that produce divergence, which is when stocks move adversely to my signal, which typically indicates that I should be short or looking for a pullback to follow. If I start seeing it's grinding up or breaking out still, then I have another system that basically tells me like, okay, there's a possibility that there could be a fake breakout or something like this. And in those situations, I still do manage the risk. I'm not adding to a loser or anything like that. But like, I have a plan to immediately capture that move once my initial risk is breached. That's basically how I would say is better, because I've tried lots of things. I've tried I was like, well, if it's going to just fake break out, I might as well just add into a loser, increase my exposure, increase my risk, and, whatever. But the problem with this is, number one, you're carrying a losing position that even you add into it, the only way you would materially be able to move your average costs up to a point where the risk reward's even better is if you put more size on, which is like, sure, it's appropriate because you're risking higher and closer to the risk level, but at the same time, like, there's no telling how far something can spike. And if you end up positioning higher to increase your average cost, it only just increases your exposure when things go wrong and can lead to a lot of bad situations. The better thing to do, actually, in a lot of cases, is just to take the loss and reinitiate a position that, numerically you'll have more position size because you're closer to the risk level, and should give you much better risk reward while controlling the risk at the same time. That's just kind of how I see it. You can, I would really advocate not to add to loser like majority of the time. So even in those cases, I wouldn't even put on a full risk. I would have a very wide stop to account for volatility, and then I have a secondary kind of like confirmation signal for myself that, okay, now it's time I can add in the risk and pull my stop down. That's basically how I would attempt those hive-day clearouts, because for every one that fails, there's going to be a ton that just keep going. And you can't assume and be so cynical that you think every single time it breaks out, it's gonna fail. Like, sure, there are some markets that feels like that, and you're gonna be frustrated with it, but at the same time, you should be able to recoup that with proper risk reward. And also, like, if you did end up maxing out before that happened, then you need to probably evaluate your strategy as a whole and your system as a whole, because that's one. And number two, it's possible that the stock was just really difficult and you should have stopped out, because like there's plenty of times where, okay, well, it works out, but then there's plenty of times where you take the max loss and you think you should be back in. So maybe let's say you increase your max loss attempt by 1 with your broker, and then all of a sudden you just take like another max loss. Like the stock just ultimately does end up towards the highs end of the day. I mean, there are so many what ifs, and humans, we tend to have a really bad like idea of risk. We're more like influenced by rewards, so we're thinking like, well, if I add to it instead of losing, then I'll make bigger money or whatever. Like, that you have to avoid that. You have to take it from me. Obviously, you might not learn this lesson unless you experience it yourself. So pretty much just reiterate, you need to risk appropriately to your account size so that you can, stomach all these lessons and all that. Learn for yourself. Like, no matter what I tell you, you may have to just experience yourself. So just be careful with that. It's just because you breach a high and you can get more shares on, like, from the existing trade range, doesn't mean that it's an ideal trade location at all. That's the reason why I wouldn't put on full size, is because the range hasn't even like developed. Once you break the highs, there's still a price discovery aspect to it. Price and momentum can carry forward, and the high could be way farther from that level than you thought. So that's the reason I would never enter into those trades with full size. I would always have a small size at that point, with a wider stop. So just be aware of that. Like, be aware of the dynamics that it's not ideal it's mostly ideal if that level is expected to hold from the beginning, and you can take advantage of the risk reward there. So just be aware of those two different nuances with the fake breakouts. Cook says, one thing I've gone back and forth with myself on in this topic: if you always wait for the optimal risk reward, the ideal trade location, you will inherently need to trade. You would need the trade to go against your bias to get there. The problem with this is that you will always catch all of the losers, but you'll miss many of the winners if you only take those trades. And these are the ones that work really well to boot. Thoughts on this? Okay, so exactly, but if we're short, we're trading mean reversion. It's just the nature of shorts. So the only way we really combat this is through the risk reward process. And the idea is that you always take like minimal losses on the way up. So we use combinations of starter positions. We use combinations of, risking relatively small to our count. And we aim to make multiples of our risk if we're right. And if you do this correctly, it will play out properly, because it's the same concept that we talked about, the equity curve sim. We have if you have a 30% win rate, but every single time you're right, you make 5R, and every single time you're wrong, you lose 1R. And every single time for the risk, for the reward side is obviously, that's a fantasy, but essentially those opportunities do exist when you are trading in the ideal location, trade location. So the idea is that, yes, you will have a symmetrical, like, okay, I can lose one, and we have no idea whether or not this trade will work. So let's just to say that, like, we're not going to make 5. Let's just say we make like 2 or 3, right, on the way down. Sure. Ideally, we structure it so that it's not 1-to-1, it's not 2-to-1. But even if it was, the difference is that when you put the position on, you have 2 controls, which is you can put a starter position on, so you take half or less of what you initially would intend to risk. And number 2, when it works in your favor, you are able to add into that winner to increase the statistic further and the skew of the reward side. So because we don't add towards a loser, we always take the intended loss or less, but we never take more than the intended loss, which is the control aspect. When you have control of that, then you understand that the reward side becomes much more appealing and much more obvious towards why it would be profitable to trade this way, versus like taking the loss every time because it's going against you. Sure, but the thing is, like, that is the risk level. Like, if you don't use that level, then anything between is going to get screwed over. So I hope that makes sense. The hard part for a lot of people was like not taking the trade or sizing down the trade, which I also agree with is hard for me. But you guys caught some of you caught the guy I talked about, Tom, my super good trading friend. He basically said, I risked that 1% on his A setup, and then sizing down on the B and C. And to me, this is just way more logical than exponentially sizing up, because like if you, for every time something happened where it's an ideal trade location and an A plus like big picture setup, and you say I'm gonna go 10x, then in every single one of those situations you would always take a 10x loss as your control, right? And you may not ever get that situation for a week, for a month, or even it might come very infrequently. So let's say, for example, you took 2 A plus setups with the perfect ideal range, and you lost 10R each time because you thought it was an A plus setup. Then now you're down 20R. That could wipe out your whole weeks of progress, still using risk reward and using R and things like that. What makes more sense to me actually is just the sizing down. So let's go the reverse direction, exponentially size down. So when you have a shitty ass trade, instead of risking more on the ones that are great, just risk less on the ones that are shit. Because ultimately, if you look at your aggregate of like net win and net loss as a trader, and you collect that data like I do, you'll see a lot of times, like, let's say you make 50K, you probably lost 100K and maybe won like 150K. But if you can somehow reduce the losers, you'll basically be effectively adding to your P&L, reducing the stress and not like, affecting yourself in the sense that like you start taking all these shitty ass trades with your full size. And I think that plays out a lot better because it's pretty much along the same lines as the principle I talked about with risk reward, where if you literally just lose less, you increase your risk reward already without risking more. You know what I mean? So if you lose less on shit trades, it should have a similar effect on your P&L, where the ones that do work on your full size you will actually add to your P&L without increasing your exposure into the market and increasing your chance of ruin. Now, obviously, like 1% can be a little bit for a lot of people. I would say like my definitive answer for this is that 2% is okay, but 2% is actually pretty aggressive, and that was one of the indications that or that was one of the aspects of my trading that led to my blow up initially, because I was just like, you make 20 R on 2%, the next day you have like a massive increase in your risk, and all of a sudden like you can't manage anymore. Like it just goes real fast. And I would say like 3% is actually really, really bad. Like you do more than 3%, I think the chance you blow up is already increased by a ton. So let's say 1% is 100 times, 2% is 50 times. 1% it already increases your exposure by you already lost 50 attempts right then and there from 1% increase. 3% you get even less than that. So be very careful, especially since you take day trades, and if you have like 2 positions maxing out with a 3% risk, you can literally lose like 20% of your account in like 2 max outs. You understand what I mean? So you gotta be really, really careful with that. I would recommend to use like 1%, and then just size down exponentially. Or you can say like 2% is my A+ setup, and then size down 1%, 0.5%, something like that. You know what I mean? Like, let's not get too crazy with it. I think if you reduce your risk, you probably make more in the end, especially through compounding. What about fractional Kelly criterion? I think fractional Kelly criterion, I did retweet something about it. It was getting kind of contentious, so I just stopped. I took the retweet off, but essentially, like Kelly criterion is based on the odds that you can calculate like objectively. Like you're talking about card games, talking about casino games, you know what I mean? There's no specific odds in your trading. I mean, yeah, you can gather data, but I've seen so many times outlier moves. I've seen so many times people's back test 1 year, 2 year, 3 years is completely unprecedented. I mean, there's no fucking odds. The best odds you have is having an edge that you win more than you lose, like whether it's 50% of the time, 60% of the time, whatever. But more importantly, your risk reward on that trade. Like winning, we all know winning doesn't really matter if you can't win more than you lose. So that's like the number one control. And when you increase your exposure randomly towards the loss, you immediately completely invalidate that whole system and increase your exposure towards risk reward like significantly. With Kelly criterion, a lot of the times, like, think about it. Nobody is cocky enough to use the full Kelly criterion. So what the fuck is the point, right? If you can't use the full Kelly criterion, that means there's something fucked up about it. And if you use 1/2, use 1/4, what you're gonna find is you're gonna get the same percentage a lot of the time as if you just use 1 or 2% of your account. Like I've done the Kelly criterion before, and I use the fractional like on the calculator, and I put in all my stats. Okay, I took all my aggregate of stats. Okay, on average 30% win rate, 4-1, etc. And it literally spat out the exact same risk I already used. So why the fuck would I go through all the trouble to input all these stats and gather all this data when I can literally just use something that's completely objective, that already accounts for risk of ruin, already makes a lot of logical and intuitive sense? Why would I go through all the trouble of calculating the same thing with fractional Kelly? It doesn't make any sense. You don't need that bullshit, and there's no way anyone can calculate the odds exactly. So I think it's just a waste of time. Like honestly, just waste of effort. You can do the same thing with just risking, based off your account size essentially, and then just determining based on the position of the stock, ideal trade location, continuation trade, how much risk to apply. It's it's that's going to do you far more good and be more like snappy, more responsive in real time than anything else. D22 said, adding to the winner, I guess I would need a system to determine why the trade is working versus discretionally moving in your favor and running average and largely. So pretty much adding to winners is mostly discretionary, but the thing is you can add systematic elements to it, such as time, or you can add larger time frames into your equation to basically give you indication, okay, maybe it's time to add. A lot of times you have to just think about it this way. So let's say that you get an ideal trade location and you're up against like the risk, right? Like the defined risk of the range. If that risk holds, then you know that, okay, that's a point where I can determine I'm wrong if the trade works, right? And you have to constantly reevaluate throughout the trade. Like, if it gets to this point, will I know for high probability that I'm wrong, right? So only reduce the risk when you like see like a big move, or you see something that indicates to you that the pressure is there or that the selling's there, and that you can confidently say, if the price grinds back to this level after having this move, I'm completely fucking wrong. That's the only time you can add, and that does have an element of discretion to it for sure, but there are ways to systematize it if need be. I would say it's going to be a mix in terms of ads, which is why I never recommend it to any intermediate traders, and even I would say for advanced traders, you still have to build your bankroll and your understanding in order to execute on this, because it will fuck your stats up. You have a 50% win rate, you're going to go down to 40%. If you like, if you're used to having 3R wins and then all of a sudden you add in incorrectly, you reduce your stop, you reduce your average, and the price doesn't move, it goes sideways, or it grinds against you. Now all of a sudden what would have been a profit turns into a break even or a loss. This can happen as well. So you have to be very careful with implementing the idea. You have to just have it in your mind, like, let me execute a strategy that's profitable, number one, and then let's start tinkering with like, how can we evolve towards that direction? Like, maybe it's adding like a tiny bit of size to add. Maybe it means you've traded that system enough that you can basically determine that, okay, well, I can afford to, like, number one, I can afford to take a capital loss on the experimentation because I have enough. Or number two, you can understand that it's going to affect your stats, and you're ready and willing to revert back to an older system that does work. That has to be in place before you can start doing these things, because the more randomness you invite to your trade, the more that you're going to get stopped out prematurely, the more emotions can occur, the more you're going to revenge trade, the more things are going to fuck you up. So you got to be really careful about that. Is there a size you would go up into account value before moving exclusively to 1% if you're trading at 2% risk? I think that one's for each person's strategy to define with terms of liquidity. Personally, I think like last year, when you get into the 5-figure risk, like 10K plus, you may start wanting to adjust your percentages, because liquidity can become a problem. It doesn't start exactly then, but I would say like the difference between then and now is that now is way more liquid. So it's possible that even at a $10,000 risk today would be far more liquid than before. So that is just something for top traders to understand and deal with. That's why you can't just like be at like 5K risk as a trader. Say, oh, I got this shit. Let me go 3x on this next trade, and all of a sudden you're risking 15K, and because it's your A setup, whatever, and now all of a sudden you're getting slipped out of your ass, and all your wins are less, all your losers are more. Or even you don't even get filled and you don't know what to do anymore, because your stop was the reason why you're trading well, and this is the first time like on increased risk. Now you're like facing adverse movements, and all of a sudden you're screwing yourself up. And that's why I said, God forbid you risk like 10x of your normal size, and then there would be so many things you don't even understand, like you would never be able to understand about liquidity. And it's so underrated and so not talked about. But you can't just skip those levels arbitrarily. It's you have to understand what happens. It's not like people want to say, oh, you can make $100 a day with this strategy, then you can make $10,000 a day with this strategy. It's not. It's absolutely fucking wrong. Every single level within your strategy is going to have a liquidity threshold that you have to experience and start to overcome. And in doing so, you're also going to have to understand how to filter and select out trades based on that liquidity. So it's like if you have a scalping strategy and you think you can just 20 exit sometime next year, and then all of a sudden you put yourself in that position randomly, you have no idea what the fuck happens when even at 10 times your normal risk, that like how your trades are affected, then you're gonna screw that trade up so fucking bad, and it's gonna hurt real bad too. So just be really careful with that. This is why like the idea of exponentially sizing down makes way more sense to me, because you at no point in that process are you ever putting yourself in a position to experience something you've never experienced before. You're gaining money by losing less overall, and it plays into the entire philosophy of like treating yourself as the casino, just playing more hands. Whereas on the other side, it's like you may hit a jackpot, but then all of a sudden it's going to make you more of a gambler than anything else. It's going to make you want to do that more. It's going to make you not accept what you had before, what you risked before. You're going to think you're something that you're not. You're going to get this dopamine spikes. You're going to risk more on trades consistently and lose more consistently in doing so, with less opportunities in order to make it back. There's so many mental, emotional things that you never consolidated or never experienced on your own. It's just like it's stupid. Like all the like very good traders, they're just fucking retired. Like a lot of them, they don't need to go 10x, because like if you make $1 million and you have $5 million in the bank, then like you're adding it on, but unless you're going to buy something massive like a house or whatever, I mean, it's kind of whatever, like at that point. I mean, it's important, but like, you know, you don't need to get to that point right away. Chances are you make it in trading, you're not going to think about it anymore. And if you do, your ambition is going to be to the point where like you're chasing things that may not make you happy, make you more stressed. You can have more money, more problems. You can have more expenses. You have more inflation in your lifestyle. You can have more. You can be like, oh, I'm going to invest in all this real estate. You have all these stupid ass tenants asking you for your attention. You got to go fix the sink, whatever, or you got to manage the manager who's managing that. You got to pay more taxes. You got to build these LLCs. You got to you have multiple spreads of LLCs. You got to do this. You got to do that. I mean, your taxes can be all over the fucking place. So I mean, like, just it's not a rush, man. It's not a rush. You just gotta. Once you get there, then you get there. You know what I mean? There's a really good quote. Not really appropriate for here, so I'll save it. But I shouldn't even bring that up. But basically, there was this 20 years market maker, and I will share it actually since I have it. 20 years market maker of options. He retired recently. Not recently, but he retired in the last couple of years. And he wrote something I thought was really interesting. And I'm going to put that on the in the chat. And ideally I can bring it onto the screen as well. Oh shit. Second. Wow, it just downloads when I want to open it. Okay, well, I'm just gonna put it in the chat. I'll read it for the people who see the recording. So he says, you will never walk away from money without a reason, but money is not fungible with risk. Actually, it's a risk absorber. For many, the feeling of a life well lived requires risk. It is if you accumulated more money than you need, you have sterilized a lot of risk, and you've sterilized the feeling of being alive. There are many types of risky pursuits. Some are fun but not meaningful. Some are meaningful but not fun, and everything in between. Before making any changes to your life, think about the size of risk you need to feel engaged and the nature of the risk you need. In parentheses, where is it on the fun/meaningful spectrum? With the answers to these questions, you'll know whether you need a new hobby or if you need a man to come through the door with a gun. And if even if that sounds really silly, it's like even I experienced this myself, which is why I even brought it up. Is like I literally thought I could just retire for the whole year, like in January, basically, and I thought maybe trade like 3 more years, and I'm fine. Like I would just take it real easy, and you know what happens? Like throughout this year, even there's no great opportunities, or maybe there's like shitty opportunities. I just keep taking the risk. Like I stopped feeling the risk in my trading. I stopped feeling like, well, if I wire out, then it doesn't matter. It's just another zero. It's another dollar in the bank account. Like it's already stacked up, right? And I was just thinking, well, it's becoming very sterilized, and like you basically subconsciously by taking losses and just like letting my drawdown, keep going and things like that, instead of like analyzing, well, I'm losing money, I should just stop trading or take a break because this market sucks dick. I just keep coming back and like losing to the point where now I am engaged because like I feel more risk towards the money. I feel like I want to make money, and the money becomes more important to me and things like that, and that it feels meaningful and engaging. Like it sounds stupid for him to say, well, you might need a new hobby or just a man to come to the door with a gun. Like that you may self-sabotage to the point where you literally feel again when things become sterilized, when you remove all the risk from your life. And that's why I'm saying towards the aspect of like, if you just, for some reason, you put like $100 on a trade, you put your whole account there, and you win the jackpot, whatever, like at that point in time, you could potentially just sabotage all of that for the fact that all of a sudden there's no more risk in your life. You don't care about the money anymore. You have too much money. You start buying fucking monkeys on NFTs. You start buying stupid ass Lambo. And all of a sudden, like, once all of a sudden you run out of this money, then now you're like, oh my God, I have to sell this. I have to liquidate my assets, or I have to like pay this huge ass tax bill, or this Lambo has literally cost me like $50,000 a year to like do maintenance, or every 2 years or whatever. I don't know what it is, but you know what I mean? Like there's so many things that will come to bite your ass, and it's so much better to just be like getting there appropriately while maintaining perspective and not self-sabotaging, things like that. But like it's the same thing that Charles Harris mentioned. Like if you go watch that interview, you've never seen it before, the speech, it's in the All Trading Content Charles Harris interview, or you can just Google it. Not interview, the presentation, sorry. At the end, he just hits it with like the massive banger of the fact that like, he had his wife, he had his family, he had everything he wanted, and he ends up divorced, and he ends up, like losing money. And like, how does that happen to somebody? It's like his internals were all fucked up, despite the fact that he got there. That was a insane presentation. So that's why I just don't see the idea. I don't see the point in like pressuring people to be like, you gotta get there now. You gotta put that 50x bet when your ass is, when you're so scared and you think you're gonna lose, but it's the time. Like, dude, you're gonna fucking get there. If you just trade well. I mean, whether you get there today or tomorrow is really it's not gonna do anything for you necessarily. And you're also gonna think that, okay, I got lucky. Number two, now this is the only thing I live for. Like, if I bet, I've talked to traders who go to Las Vegas and they just drop like 500K or $1 million, just lose it and fucking gambling because they don't feel anything anywhere else. He was like, I just lose $1 million, and then I just make it back in the market, and then I come back and I just lose it again because like it's exciting. Like I was like, what the fuck is wrong with you? And it's like, what the fuck? What the hell is that shit? All right, anyway, so the last question before I get tired. Cook says, as systematic guy, I'd love to hear you talk a bit about when it's time to adjust your system versus when it's time to trust your system. Lots of talk to me right now being difficult, needing to adapt, etc. Would love to hear your perspective, maybe some examples of exactly what adaptation looks like to you. So So system is very important to have like understanding of the long term, right? And of course, you have to give yourself at least a month or two to experience it. You have to understand the cycles that you're in as well, whether it's a bullish cycle or bearish cycle. And like with that knowledge, you kind of have to learn that from experience. Of course, you can ask questions like, "Oh, what kind of cycle you think we're in?" And I can answer, or even like at some points in this year there was a completely neutral cycle. Like there's no one's winning, no one's is going completely sideways. I mean, this is kind of not normal activity. I mean, usually in the past you go one side's up, one side's down, one side's up, it's like that typically, but like starting to see more of a slower market, I'm starting to recognize like neutral market does exist. So like within those three kinds of markets, you have to understand like how it interplays with your system. Like, so for example, the other day, VJ or Vilj, I forgot, he mentioned that he only shorts strength, but shorting strength on the system is only going to like happen when it's a strong market, like a bearish market when there's more sellers in control. A lot of times there's no push or whatever. So it's like if you trade only fake breakout and you never see them, then of course you're not going to get any results, right? So the idea is that you understand what market you are in, and if you're okay with like sitting out or being selective, whatever, that's really cool. That selectivity is always a good thing. But if it's different, if for example you are trading and you are seeing opportunities and you are losing, so in those cases you have to basically figure out like, okay, is something actually changed, or is it like, am I missing something within the three pillars? Like, what's actually occurring with the news, fundamentals, and technicals? A lot of times it is technicals first, in my opinion. So it's like, all of a sudden you're trying to trade all these multi-day runners like they're day one or like they're gaps, right? But they're not. Like I've explained in the past picture, it's like there's volume occurring on different days within this range, and you're just picking one of those days, sure, but you're not like actually part of that big picture. So you just have to get very specific within those setups and then apply systems towards those setups. So like, would I trade would I trade this here like I treat TSHA? No, I wouldn't, because they're completely different. And the more you understand, like, you can literally just take a look at the daily chart. First of all, this is a fucked up chart. It's like this chart, I don't have it on me, but basically it's a downtrending piece of shit, needs cash and ATM, and it has a history of failing, right? This chart has been on an uptrend with massive volume, let alone not even really threatening any long positions. So it's like, you're going to have to make specific as much as possible, like what number one makes you money. So in your second year, you should have identified your consistent setup, and you should know exactly what that looks like. And a lot of times where systems kind of go wrong is where people, they kind of trade it well, and then they are disciplined and all that, and then they just start like going out of their way to trade other stuff, but they trade it kind of very similarly or like sort of similarly. And then that kind of leaks into their main bread and butter. And then you have this kind of weird amalgamation, right? If you can kind of separate that and be like, well, this is what I do and this is exactly what it looks like, this is exactly what it needs to see, then when you see something else, just say like, okay, this is the variant. Now define like, what is the optimal way to trade this variant? And then look at basically like all the examples you have in the past and be like, okay, that was different. Oh, that was different. Can I subcategorize this to something else? Because like under the umbrella of mean reversion, you have all the kinds of things. I mean, yeah, you can mean revert a multi-day move. Absolutely. Is it going to look different? Absolutely. Will it sometimes look the same? Sure. But if it does look the same, then sometimes that tricks people to be like, oh, I could have traded that way. The thing is, you have to just be able to separate exactly what you're built off of first. Make that completely specific. Take the knowledge you acquired to be consistent at one thing and how you built the systems up to approach another problem apply similar mentality but recognize it's different. And if you can do that, and you can allocate risk even appropriately, like risk down if you're not sure about it, then you pay the tuition that's necessary without putting on full putting full risk on, which impacts your portfolio or your bankroll over time. And you just backtest that system, whatever, and then once you can literally go into the trade like on the day and be like, well, this is this setup, and for this setup, this is how I trade it. These are my rules for that setup. Then you know that you're implementing the correct systems. But I would wager probably a lot of people like myself early in the year, like I just got lazy with it. I was like, well, I got trade that. Oh, it doesn't work. Fuck. Versus like you get that feedback, you should be like, well, to be absolutely disciplined, I'm losing money. So let me define every setup I'm taking. It should have a name, and it should have a system associated with it. So it's like if you wake up in the morning and you get all the scans, whatever, and you parse through it, if you put that up and you intend to trade it, you should be able to say that's a failed fall through setup. That's, ATM dilution setup, like whatever you want to call it, right? But you should be able to give it a name right then and there. And if you can't, then that is signaling something incorrect about, your process, because like you're not trading without edge, or you're trying to overlay something that is similar but not exact to another trade, and it's just you get away with it enough, but I would wager like over time it's going to be really frustrating, and it might get to the point where, again, like I said, you forget what was exactly your shit, and it kind of mixes together, and all of a sudden like you optimize for one thing, you start trading your bread and butter through that optimization of another, through that optimization, which creates like a Frankenstein effect. You're no longer trading that well. I mean, it's totally fucked up. But for the original question, if it was a healthy market, there's healthy cycles, you understand the cycles, give it at least, and the backtest is proper, you look back and it works. You got to give yourself at least like 2 months. It's hard to do that, but like that's the hardest part about trading, is that people have no idea how to stick to something and be consistent. And every system is going to have losses. Every system is going to have bad beats. But, you have to understand it. And through time, like if you go and look at some of the videos I have on YouTube and stuff like that, you'll see like, I will literally be like, well, I had a month where just nothing going right and I'm red. But over the course of the year, the same system is performing extremely well. So if I had like taken that month as a cue to like change something, then I'm not understanding how trading is actually done, which is a series of trades. And the fact that the aspect of time and like differentiating things by week and month and stuff like that and day, it's all made up if you think about it, right? It's like, why should it matter if you're up 100R in November and then December you're minus 30R? Like aggregate your 70R plus, but like because we divide things into and try to categorize them into time, you lose sight of the fact that like the market doesn't give a fuck about that, and also a system doesn't give a fuck about that. We use those as points of like resetting so that we don't get overwhelmed with information, like or that we start anew. And like humans like to do that. I like to do that. I like to be like, well, let's put that year behind me. Let's start new. Let's put that month behind me. I want to set my mind. Like we kind of need that to stay sane, because if we were thinking like completely logically and like everything's all together and all mixed up and every sample is a drop in the bucket, Monday and Tuesday is the same shit, it's just two trades that happened, and it's like it's just too overwhelming, you know what I mean? But you can't also fool yourself and think that like a month span is the reason why your system no longer works. It has to be through the grand scheme of things. Like imagine imagine casinos are like, fuck it, this guy won the jackpot in the slot machine. I'm just gonna take it out now. It's not working, man. Or the roulette. Oh, too many. Like just like 3 winners this week. I think we're supposed to have 1. I don't know how the fuck that happened. Fuck this game. And then all of a sudden, they have no more law of large number games, and they're not making money anymore. You know what I mean? It's like that's not how you. That's not how you're supposed to think. But the thing is, when you add so much variance to those numbers, like you're like, I'm gonna go 20x on this one. I'm gonna go 5x here, the 4x here. I mean, like, there's literally no control in this. You're just hoping. You're basically hoping that you pull ahead so much that nothing is gonna hurt you in between the next hit. Whereas, like, if the casino is not really acting that way, they're just like, oh, here's the odds. Have at it. Just in fact, just play it a million times if you want tonight. There's no clocks, there's no windows, just fucking go. Like, they want you to just sit there and keep spinning. It's like, that's how you got to kind of think about your trading. Is like, no one situation is really that important, and the ones that do pay out will pay out when they do just come naturally. Like, for example, there was a trade I took the other day where I got like a 6 or 7 R on a 1, 6-7 to 1, right? So it's like, how does that happen? Well, you're in an ideal trade location, number 1, and number 2, the trade's trending for me. I identify with my system, with my experience, and with my intuition that I can reduce my stop to this point, and this point, if it goes against me, I'm invalid. And because of that, when it gets to my price target, which is, quite good, then I get a massive multiple on my risk. And that just happens as a result of the trade offering the opportunity to me. Whereas, like, you can have that same opportunity, ideal trade location, you add intuition, whatever. You take a loss, well, you only lose what you intended to lose in the first place. It's no big deal. Because the next time that setup happens where you do get that big multiple, that eats up so many of those losses. And as much as you can reduce kind of the variance in terms of, like, okay, I took a C setup, I took a B setup, and I'm reducing my risk, then all of a sudden, even more so, because, like, where 1 R would be equivalent to 1 attempt, like, let's just say every time you won, you buy yourself 1 more spin of the wheel. If you reduce the risk on those trades that suck, then all of a sudden that 1 becomes 2 tries. You know what I mean? Like, it has an exponential effect on your ability to sustain and also pull ahead in profits. Whereas, like, if you always vary, like, the degree at which you'll hit it, then you have no idea if you're going to have a 10x opportunity once in 5 months or once in 3 months, once a month. And if you had that opportunity 2 times and you lost twice, then it's just completely fucked up. And you have no way really to recover that aside from waiting for the next one or having a string of multiple wins. It's like, it assumes that you're always ahead. It doesn't assume that you ever lose. And in fact, I don't never hear nothing about losing in terms of how you deal with that. But if you manage your risk properly, you understand, like, you're buying time for yourself. Like, you buy losses, you buy mentality through those wins. So, with everything combined, like, throughout this webinar, I hope you understand that, number 1, ideal trade location continuation, that's something that you should always think about in your trading. Reiterate to yourself, contemplate on it, understand why. That makes a lot of sense. No matter how good a setup seems to be, you still need to put on the risk appropriately for the position that you're taking. It's if we want to use poker analogies all day, we can just say, well, you got pocket aces, and you could all in, say it's the best hand in poker, you can all in from the pre-flop, but it's better to kind of, like, just bet normally or bet a little bit higher, let the flop play out, and then see all of a sudden, okay, there's like a 2 5 and a 7 on the field, all offsuit, like the chances that someone hits you with another hand, even though you have the best hand, goes way up. Your chances go way down. Doesn't matter if you have pocket aces because the position you're in is not an ace situation. So you just have to think about that. And these are things that I'm still working on, but like I've thought through it enough through different perspectives and considering the other perspective as well, that I can tell you it's the right thing to do. And my career is defined by having a consistent base and being able to project into the future, like something to strive towards. So it's like, if I had 3R average win, then I would say, well, I want to start like, eventually I might want to start adding to winners when I feel comfortable. Try to get to like a 4 maybe. Or in this case, I want to work towards being able to put on less position size on trades that are not worth it. Ideally, I can just not take them in the future when I start just getting sick of it being a waste of time, and start considering position size as a function of where my position is relative to the risk, and defining my setups to the point where I know exactly how to trade every scenario. I can name it before I trade it every day. And with naming it, I know this works, this doesn't work, this is the rule, this is when I need to get in, this one I need to get out, etc. You put all those things together, they give you pretty fine. And pretty fine's pretty good considering this market. And, you build those tools, you make the mistakes, you learn from the mistakes. Teaches you that you didn't deserve to be where you think you should be with your expectations. Like if you really think that you should be managing like massive positions and you're such a good trader, then you shouldn't be making such a stupid mistake in the first place, right? You make that mistake today, don't be disheartened. You should be inspired because it's like, oh, thank goodness I didn't make that mistake like in the future. I make that now, I'm going to be a better trader tomorrow. And so as long as you can keep working at that, give yourself more time, that's perfect. All right, anyway, so this will be uploaded. I'm gonna end it now. All right, so let's end it now. Thank you for watching.